Welcome back to Market Shares. I'm your host, Tony Blodgett. And today, got a handful of things that I want to touch on, just things that are going on in the market. And we're going to start with the Fed rate cut and the impact it's had on interest rates. Now, I did an episode after Jerome Powell lowered the benchmark overnight cost of funds rate by 50 basis points, the Fed funds rate by 50 basis points, which in my opinion, as you guys all know, is very welcome news. And I got to be honest with you, I was expecting a little bit more of a rally in the mortgage market, after that happened. And not only did we not see a rally in the bond market, we actually have seen rates creep up quite a bit, actually, since the Fed rate cut. And this isn't due necessarily to the Fed rate cut, but there's a number of things that are happening simultaneously. Now, as we talked about on our previous episode, part of the challenge is that there was so much anticipation of the Fed rate cut that most of that, if not maybe more than that, was already built in to the market. So even though people were still anticipating only a quarter basis point hit, like in the headline, the market itself had already anticipated these further rate cuts. And so we didn't see the big move that we were all hoping for. But more so than that, we've seen a few other things happen. First of all, you saw China cutting their rates as well. And when you have a huge economy like China that's cutting their rates, and I think the feeling there is a little bit more like they're doing it out of necessity because the economy is, a little bit more challenged. Now, what we're doing is trying to create a soft landing, right? So as I showed in the graph, we don't have a really challenging economy. There's certainly things that are out of whack, credit card debt and, some of the repossession of cars and some things like that, but employment's still strong. Other parts of the economy are strong. We're just trying to get to that neutral status as quickly as possible so that we can kind of come in for a soft landing. The thought with China is that perhaps there's a little bit more troublesome economy going on there. And as any large world economy goes, or in a world economy with any large player like China, if their economy is starting to stumble, that's going to ripple through everybody. And so that was, I think, part of the concern there. Also, we saw a jobs number that drastically outperformed expectations. Now, I think if you look, we talked about this, right? They revised the jobs numbers last year, that had been over the previous year, down by over 800,000 jobs. So we know that these, month-to-month jobs reports are not super accurate and are often open to further revisions. And in most cases, those revisions are down. In this case, the jobs number was above expectations and they revised the previous report up. So you just wonder, what is going on with this, jobs data that's coming out? And, does it have something to do with the election? I'd sure like to hope not, but maybe it does. A lot of people think that it might. I don't know. But the reality is that when you dig into those numbers, there are some inconsistencies. I'm not going to get into dissecting that report, but one one area that really stood out to me was the number of jobs that it says were created for 16 to 19-year-olds. Here we are at the end of summer. Kids are back in school. Is there really new jobs for 16 to 19-year-olds right now? That doesn't really make sense. And even if it is accurate, are these really jobs that are contributing in any major way to the economy? I would argue probably not. And that was, a huge percentage of what we saw in the job growth. So just a lot of weird data around jobs, but nonetheless, the market reacted to it. And we saw a couple really bad days in the bond market pushing interest rates up. I've seen rates, up as high as 50 basis points in rate. And some products, some programs, I've seen even more than that. So we've seen some pretty significant deterioration in mortgage interest rates since the Fed rate cut, not what anyone was expecting. Now, does this change my outlook on what interest rates are going to do over time? No. I still fully anticipate mortgage rates coming down over time. But as we've talked about a number of times, things do not come down, in a straight line. It's not like you just get on the escalator and move down. It's going to be inconsistent. There's going to be, some ups and downs on its way. And we saw so much improvement before the Fed rate cut. I guess it's not super surprising that we're seeing some volatility now. But let's talk about what the impact of this is. I mean, gosh, there's a lot of people who were reaching out to their borrowers. Matter of fact, a lot of refinance transactions happened during this very short window we had of lower interest rates. But then there's a whole nother slew of people who loan officers have been reaching out to and getting them set up as we've been advocating to do, right? I mean, get your strike price set, get your clients ready for a refinance. And I think a lot of people right now are feeling deflated because rates have spiked up. But I'm here to tell you, don't lose your focus right now, okay? This is not the time to be frustrated because rates popped up a little bit, but they're going to come back down. We know that the long-term trend is going to be for lower interest rates. So stay the course, okay? Continue to make your phone calls, reach out to your borrowers, stage those borrowers for refinance opportunities, set a strike price on when it's going to make the most sense, and then stay in touch with those people and, keep track of what interest rates are doing and inform them about what's going on. So when the time is right, you can jump on it. There's a lot of people who were able to lock in their rate before the jobs number came out last week. And if those people locked in, they're in good shape. If you didn't lock before the jobs number came out here in October, then you probably didn't end up moving forward with your refinance. Or if you're a loan officer, you were probably scrambling to try to get a pricing exception or something to make up for this market deterioration to keep that client with the terms that you have committed to them. So that's the other thing I want to talk about here is the strategy of communicating with your borrower about their interest rate. Look, it's really important that we're very transparent when we're talking to our customers about interest rates. I'm of the firm belief, after doing this for 27 years, I'm of the firm belief that if the interest rate that is available on a given day is acceptable to the client and meets their needs, you should be locking in that interest rate. It's just way too volatile, and it's going to continue to be volatile even as rates come down, to not have a lock first kind of a strategy. Now, sometimes you meet with a borrower and rates just are not yet at the strike price that they need. You've already worked out for them what's going to make sense. Then you need to make sure that you're communicating with them that they're not locked in and that we're going to watch interest rates. And you may even want to set the expectation that we may even see rates go up before we see them come down. And so they're not surprised when you have to call them on a Friday after a jobs report comes out and says, hey, bad news, instead of getting you a rate of 6%, it's going to be 6.25%. No borrower wants to hear that. And no loan officer should make that phone call. What you should do is set the expectation with them that it might be a little bit of a rocky journey. We need to lock you at 6%. And if rates go up between now and then, we're close. We could get there. But if we don't get there, no big deal. I'm not going anywhere. I'm going to be here. I'm going to monitor rates for you, and we'll get your loan locked in when the time is right. And then set that file aside, put it on a follow-up campaign, and go get another borrower that's ready to establish the right strategy for their needs for when their rate gets to where it needs to be. We need to be constantly prospecting, adding loans to our pipeline, not sitting there getting frustrated or spending our time trying to solve problems that we've created for ourselves by not having proactive communication with your borrowers, setting the expectation. And look, it's okay. It's okay if rates go up and you miss a small window of opportunity. There will be another opportunity. It just may be down the road a little bit. So that's what I would say. Now, if you've taken your borrower through the underwriting process, you ordered an appraisal, you've done all these things, and you didn't lock in their interest rate, shame on you, in my opinion. I think that you need to lock in an interest rate with your borrower before you start committing them to spend money on this transaction. Make sure that you're able to offer them the terms that they're looking for. We can't have such a scarcity mindset around this, that we have to get this loan done this month, this week, in order to, pay our bills or whatever the case may be. That's, in my opinion, not the right mindset to have with your borrower. We're here to help them. We're here to give them great advice. Be proactive with your communication. Be transparent with your communication. Be okay with the rate that they want moving away from you for a bit, because it will come back down. So I see a lot of people struggling with this right now, and a lot of it is self-inflicted. Now, look, I get that some people strategically made a decision to hold off on locking their rate. Maybe even the borrower agreed that, hey, given all the information, I too, as a educated borrower, think that interest rates are going to get better. So let's just float it and let's just see what happens. And they were willing to spend the money on an appraisal or whatever. Those circumstances, can happen, but it creates a lot of undue stress on everybody when you let your borrower get into that position. So I would encourage you not to give that advice, to not take them down that path, but better find the rate that works when it's available, lock it in, give yourself 30 days, and then move forward with the closing of that transaction. I mean, pipelines are not so full right now that you should easily be able to close a loan in a reasonable locked timeline. So anyway, that's my thoughts on interest rates. Let's still be confident in what's going to happen with rates. Let's not freak out here, and continue to prospect for refinances. Don't lose your focus because rates popped up a little bit here. The long-term trend is improvement, and the good news is you have more time, right? You have more time to build that pipeline and be ready when they dip again. So embody that mindset and you'll be much better off. Now, a few other things that are going on in the market. Now, I don't know exactly when this episode's going to air, but I'm recording it just a few days before landfall of Hurricane Milton. I hope that when this episode airs, we hear that, Hurricane Milton, deferred, went off course, moved south and avoided, Florida and the Tampa area where it's currently predicted to make landfall. I hope that that's the case. I don't know what the future holds, but what I do want to speak to is what happens in the mortgage process during these natural disasters. And we just saw Helene come through and do some significant devastation, some in Florida, but what's happened in the Carolinas is unbelievable. And, our hearts go out to those, not just families, whole communities that look to have been, annihilated. It's just really sad to see, but natural disasters are a reality. And in the mortgage industry, what happens is we have to pause fundings on these homes because, and a lot of people say, gosh, it's not the borrower's fault that, a hurricane's coming and now you're going to make their loan not close on time, right? I've heard people say this, but you got to think about this for a second from the lender's perspective, which is the collateral for that loan is the home. And that loan is going to be sold into a pool of assets. And one of the requirements of that security is the collateral that supports that loan. So it is the lender's responsibility to make sure that home is still standing at the time that they fund the loan. And so you will see mortgage companies for that reason typically put a pause or a freeze on fundings in areas where they are expecting this type of a natural disaster, specifically the kind that you can see coming, like a hurricane. And you'll also see it when there's some sort of a large devastation that happens in a market, and we know a lot of damage was done because of flooding or earthquakes or things like that. And until damage can be assessed. They might freeze fundings just to make sure that the home is still standing and still in good standing, right? Meaning it's still structurally sound for that family that's purchasing it. So it does protect buyers a little bit, but it also protects and make sure that the overall security instrument is perfected by making sure the collateral is intact. So just be aware of those things. I thought I'd mention it because I've heard it come up a few times, and it is the lender's responsibility to watch for those things and make sure. The other thing that I'm really concerned about with these natural disasters, and specifically with Florida, is insurance. I mean, insurance, we've talked about it here. I was really hoping to get an insurance expert on the market shares, and we still may do that. But insurance premiums are crazy. I mean, we saw what happened in California after the wildfires that they had year after year. And, the major insurance companies wanted to increase insurance premiums. And sometimes what happens is you have your insurance commissioners who will limit how much a insurance provider can increase their premiums. And that's a consumer protection thing that they have in place to say, well, you can't raise premiums 40%. You can only do maximum 20%. And those insurance companies will just pull out of doing business in those states. And we already have challenges in Florida. And now I'm hearing about significant increases potentially in, North Carolina and I'm sure in Florida. So I just see this further exacerbating the insurance challenges that we have in this country. And look, they can try to make up some of their losses through increased premiums in those high risk markets, but also know that they have to spread that cost over all of their insurance, clients as well in other states. So this doesn't just impact these disaster areas. It will impact insurance premiums and continue to put pressure on the insurance industry, I'm sure. So it's just really heart-wrenching to see this happen, not just for the families, the towns, the communities that can be destroyed, but the other impacts that it has. I mean, flood insurance is another one. I mean, most people can't even get flood insurance in Florida right now, where it's very difficult to do so and very expensive if you can get it. And we know that there's going to be significant flooding that happens. So even if someone's house doesn't get destroyed by a hurricane, it very well may be destroyed by flooding. And we know there is a ton of people that are unable to get flood insurance. I mean, we got some real challenges around this area right now. And I don't know what the solve is, but I hope that there is some resolution in the coming, months or years to really help the insurance industry. I don't blame them necessarily. I mean, they take the brunt of this. They're trying to protect, their shareholders, their business from failure, but something needs to be done. And I'm not sure what that's going to look like. So just keep that in mind as we see stuff like this. It will have a ripple effect across our industry, and insurance is one of those things that everybody has to have on their house. And when premiums go up, it impacts people's payments just as bad as if their interest rate went up, So it's not great on the insurance front, but I will push to try to find a really good person I can have on here, and we'll talk more about what's going on in the industry and see if there's any, future solutions that we can see coming that might help out. So you guys, that's what I wanted to cover today. Look, don't be down because interest rates have popped up here for a minute. It's okay. It's okay. And I think those people that are the most stressed are the people who maybe didn't do the best communication with your borrowers. So next time around, as you build your pipeline, as you get people positioned for taking advantage of the opportunities this market will present to us over the next year, 2 years, be careful. Be careful with your language, and also recognize that sometimes these opportunities to lock in your clients can be fleeting. And I think this is just one of many dips that we're going to see where you got to have your ducks in a row. You got to be ready. You got to lock in a rate when it's right for your borrower, because I do not think this will just be a straight downward move. This is going to be a jagged move, right? Barry Habib is pretty famous, I think, for using the analogy. It's like a kid with a yo-yo going down an escalator. And the yo-yo is the market, right? So overall, the trend should be going down, but it's going to go up and down just like a yo-yo on its way. And you got to find the valleys and don't be surprised by the peaks, and set those expectations with your borrowers, and really set those expectations with yourself so that you don't get deflated, you don't get frustrated, because as we've talked about on other episodes, this is an industry that's a lot driven by mindset. And there's things that you can do, like being prepared, being open and honest with yourself, that are going to allow you not to get mentally frustrated when something like this happens, but keep you focused on what you need to be doing, which is that income producing activity, building the pipeline, building the connection with your borrowers, finding those strike prices and putting those in line and ready when the opportunity comes. So you guys, that's my message for today. I appreciate your time and your attention when you tune in here to Market Shares. Let someone know about it though, right? Let someone know about Market Shares if you get value out of this content, and I will see you next Friday. Take care.